Good afternoon. Peter Klein, Chief Investment Officer, co-founder of ALINE Wealth, with you on this 28th of March after market close, so Tuesday evening, to give you a quick briefing on what we're seeing in the markets. Forgive the quick nature of this presentation, but just wanted to get it out and make sure you guys, understand how we're seeing, things around the financial markets and the world. So, with no further ado, allow me to share my screen and we'll be on our way. Okay, a little bit of a change of color there, you may have noticed. Okay, so we are proceeding. Here is our spring setup. First, I'm going to talk about macro, give you a baseline on how we see those things, how we see the economy. The case for international and commodities. This is going to be the basis of tonight's call. And then we'll talk a little bit about, as we have in the past, our very defined 2023 playbook. Strange macro picture indeed. With a lot of talk out there about a recession, yet we're not really seeing that in some of the statistics there are plenty of statistics that we're seeing that do show and do discuss what's likely to be a recessionary tea leaves in the future, and then probably in the next few months, when those tea leaves might get very much more, may get brighter. But at this point, we're seeing GDP expectations. The GDP now estimate is usually a little robust. So looking at this one, we're looking at, not a recession, right? So we're still seeing a glide path above zero. And then on the employment side, we're seeing pretty much historic lows in unemployment. So these are not the kinds of things you often see. Now, again, as I said, there are plenty of other statistics out there, like the inverted yield curve, that show that opine or suggest recession is coming. We believe that the base case very might well be stagflation, whereby we get this sort of above zero, below 1.25, 1.5 kind of rate of GDP growth with stubbornly high inflation. That's our base case. That's no fun, by the way. But the thinking is that there's a lot of demand for services, a lot of pent-up demand for travel and services and experiences. And we're seeing that is translating into the type of the demand for these types of goods rather than goods, more services. On the good side, though, we're also seeing strong demand for what we'll see as materials and especially energy-related materials. But that's a little far afield. That's a little down the road a bit. We believe that inflation will remain sticky, and therein lies the rub with stagflation. We'll see. But it's just a very curious setup right now with the pent-up demand and the consumer being so strong, employment being low, unemployment being very low, and people are spending. And that has a demand function that can certainly keep inflation above what the Fed is hoping it to become. We're seeing some movement down on inflation. That's good. We don't think it's going to be dramatic. Let us proceed. The Fed also expects interest rates to, even with the crisis in the banking system that was very short-lived, although maybe it's not. Maybe there's still some more to come. I don't think so. I think that was sort of not systemic, but specific to a couple of banks. But be that as it may, this graph shows you that the market expects the Fed to cut. We see no basis for that whatsoever in 23. So here lies a differential between what the Fed is likely to do, which is probably another couple of 25s, maybe two. We'll see how inflation looks. If it gets hot again, maybe it'll be another 50. We'll see. But let's say 225s. By the summer, they're on hold, but they're not cutting. We just don't see that. but the market expects that, and I think the stock market, is now realizing maybe we're at a bit off base. Now, what we do know, and we all know this because we live it, are costs are up. I mean, costs are up everywhere you go. Costs are up. So if you're running a widget store, a cookie store, whatever, a candy store, and your goods that you're selling, the cost of your goods, otherwise known as COGS, right? Cost of goods sold. If they're going up, what do you think's happening to your bottom line? It's going down. So margin pressures equal earnings pressures. And that's what we haven't seen yet. And that's what we think is coming. So as earnings contract, there's not much there's no real way for stocks to continue to go higher in that kind of scenario, right? So we believe strongly that earnings is the next shoe to drop. Okay. That being said, let me speak a little bit about the case for international investing in commodities. This is a great slide that shows how the United States has been the place to be since the great financial crisis, and largely due to Europe and to a lesser extent developed countries in Asia, Japan. After great financial crisis, they didn't adopt strategies as we had so aggressively, ergo zero interest rate policy, that led us to come out of some would say bubble up, and that is why the United States has been essentially the place to be versus the IFA, right? The rest of the world. Okay, and you could see here that has not typically been the case. In this box here, we're seeing the United States as the loser versus the rest of the world. Same here, and actually in this period as well, right? So it's one of these things where it's very odd to have such a long time of outperformance, and we think that that's coming to an end. In fact, you'll see it here: 157 months of outperformance, much longer than prior periods. This is when the United States outperforms the MSCI IFA, and above here is when the IFA outperforms. The IFA hasn't outperformed for 20 years almost, right? So it's a long overdue, and you'll see in a moment some of the reasons why we think it's an opportunity. Here is one such reason. Valuation, right? We always do a lot of work at Align Wealth on valuation. We believe that when you're looking at the most important factors to look at when you are now analyzing equity investments is you want to look at what the price you pay, right? What are you buying, and what price are you paying for that? And that will determine often your next 5 to 10 year glide path of returns. Well, if you look at United States, as of the end of 22, we're trading about 19 times earnings, about almost 4x book, and 13.6 times cash flow. Okay? The rest of the world, ROW, the rest of the world is trading at substantially discounted levels. Here's the ACWI, ex-US, 11.8 PE. That's almost half. 1.6 price to book, that is half or more. And then 7.8 price to cash flow. So you see here, the valuations are compelling comparative to the United States. And Japan is super cheap on a book basis. And then you can see the emerging markets down here. So from a valuation perspective, the rest of the world looks very constructive and attractive. Now, lest you think that the great companies are only U.S., I know that there's a U.S. bias to the world, the United States exceptionalism. I get it. But in reality, though, if you look at companies around the world, there are many highly profitable businesses that exist outside the United States. And you can see here from this 40% of the ACWI, it's the All Country World Index, right? All Country World Index. 40% of the highly profitable companies are non-U.S. and 60% are U.S. However, if you're looking to perhaps pick some spots, you could see here that in certain sectors like materials, non-U.S. have the most highly profitable companies based on free cash flow returns, energy, utilities. We could go on and on. So don't forget there is a big world out there. And as investors, we need to use a large and defined toolbox of opportunities. We cannot just stick our head in the sand and just buy what we know, what we feel like we know. We've got to look around, shake the trees, peel back the onion, and really look for opportunities that are going to make a difference in your portfolio, risk adjusted. This is the beginning of a couple of slides I wanted to talk with you about, and this has to do with commodities. And here again, we've seen that commodities, the equity ratio to commodities, this is the S&P versus the Goldman Sachs Commodity Index, right? So when it's in this zone here above, in this area, this is when the S&P is doing better than it had for years versus commodities, a little bit of a commodity here, then right back up to S&P. So unlike the 70s where commodities ruled, right? So more real assets versus paper assets over the last, let's call it 30 years, the old regime, what did we have? We had paper assets, right? Why? Because we had disinflation. We've spoken about this. We outsourced inflation to the emerging markets. We had immigration and women coming into the workforce, lowering the labor costs. We had unions also not as powerful back then. And we had technology, which made everything, disinflationary, right? And you had a Fed that said, I love this. This is great. Lower inflation. I'll lower the interest rate. Lower we go. And guess what happens? Markets, paper assets take off, right? That was then. We believe we're in a new regime. Get your bell bottoms out, grow your sideburns long, because it's like the 1970s again. That's what we're thinking. We'll see. That's what we're thinking. Energy markets are undersupplied. Now, this is a very important factor in our thinking. The net zero movement, very powerful. Hundreds of companies, thousands of cities and countries around the world have signed on to 2050, net zero carb output. So we're all going for it, right? We're saving the earth. Well, it's going to take time and it's going to take a lot of money. And frankly, it's going to be inflationary. The bottom line is after 20 years of undersupplying those commodities, in this case, we're looking at oil and energy markets, we don't have the supply. We don't have the ability to get the stuff to the end markets, and therefore prices will continually be higher than expected. So it's a case of supply and demand, folks. And it's really interesting how if you look back at things that happened 15, 20 years ago and how they now have impact. And I think that the movement of anti energy 15 years, 20 years ago has lessened the ability for increased supply, increased mining. And now without those goods, it's going to be a tough push to get to electrification and net zero. We'll get there, but inflation will be with us because of it. That's my thinking. Okay, Playbook 2023. Now, I start with this because it's so unimpeachable, right? It's so hard to sort of, negate this. 42 years of data, 42 years. And what it shows us is that if you miss the 5 best days, you're down 38. The base case is you invested in all the days over those 42 years, and your 10,000 grew to 1.06. If you had just missed the 5 best days, and guess what? We don't know what those 5 best days are, but I'll tell you, they are often those that you least expect it to be. Okay. You're down by 38%. If you miss just the 10 best days, 55% down. Unbelievable. 10 days out of 42 years. How are you going to know? That's why we don't play the timing game. It doesn't work. Stay in. You'll see in a moment. And then, here's the other thing. When there's turbulence out there, when there's issues and events out there, usually the snapback is powerful. So we don't want to miss those. We believe that in this new regime, active management is back to a stock picker's delight. And what this slide shows us from our friends at Strategas is that look at all these underperforming. Look at these numbers down here. You're barely getting 50. You're getting 40s, 25s, 20, 17. This is all the number of active management, the percentage of active managers outperforming, right? Then you have last year, the new regime. You see, it's hard to outperform when money is cheap and gets cheaper, when no one cares about fundamentals, when the analysis is not mattered, but momentum is. When money is free or near free, lots of things happen. But when the tide goes out, as Buffett says, we're now seeing who has been swimming naked. And therefore, now we're back to a more fundamentally focused market. You could point to some of these areas here. And now we're seeing opportunities to outperform the indices that are more market cap and more momentum driven. And that's what we're seeing going forward. And we think it has legs. We also know that compounding is magical, right? And it's important to have dividends and in growing those dividends and then in reinvesting those dividends for further compounding. That's a powerful, powerful wealth builder. So we want to own these things, right? We want to have, a portfolio and work the edges, tweak around the exposure. Right now we're cautious, but we still have exposure. Select exposure, right? As you can see right here, we're overweighting cash. We respect the volatility, remaining patient. We employ hedges to protect our capital, our clients' capital. Most important, protect capital using hedges. Now, fixed income used to be that great place where you could hide. No longer, because now we have interest rates going up, and we believe, we're not going back to that low interest rate environment anytime soon. So therefore, we have to be mindful of the risks in fixed income. Doesn't mean we can't buy fixed income, more shorter term, higher quality, and be cautious. Dividend growth, we've mentioned, value style with high free cash flow yields. Back to that fundamental analysis. Inflation centric, right? We're the 1970s again, right? Real assets, resource companies, infrastructure, tangible goods. We mentioned international. It makes a lot of sense. It's compelling from a valuation perspective. And there's some great blue chip companies that have been around for 150 years that are traded at discounts to their U.S. counterparts. I think those are opportunities. Companies, sectors with pricing power. You want to be able to pass along those increased costs. And finally, lest you think I've forgotten, let's not forget the water sector. Pipes, pumps, valves, utilities, metering, testing. Great companies doing great work, environmentally savvy, important, long runways of opportunity. Thank you. Thank you for your attention and your confidence in us. We're here to serve. Feel free to reach out to us with any questions you might have. Thank you for your attention. Have a great week.